There's a moment that repeats itself in every generation. A moment so ordinary that almost nobody notices it while it's happening. The headlines still sound confident. The experts still smile on television. Friends still brag about easy profits at dinner tables. Uber drivers start giving stock tips. Social media turns investing into entertainment. And somewhere, quietly, beneath all the noise, the foundation begins to crack. In 1929, people borrowed money just to buy stocks because they believed prices could only rise. In 2000, college students quit school to day trade internet companies with no profits. In 2008, families bought homes they couldn't afford because banks told them housing never falls. And before every collapse, there were always two kinds of people. The first group chased the crowd until the very end. They confused momentum with intelligence. They thought being late to the party was the same as being early to the future. Then there was the second group, the quiet group, the people who understood something timeless about human behavior. They knew markets don't crash because numbers suddenly become bad. Markets crash because human emotions become extreme. Greed stretches reality. Fear snaps it back. And while most people spend bull markets trying to look rich, smart people spend them preparing to stay rich. That difference changes entire lives, because market crashes don't just destroy portfolios, they expose habits, they reveal discipline, they separate people who were building wealth from people who were gambling with momentum. The truth is, the smartest investors in history were never obsessed with predicting the exact day of a crash. They were obsessed with being prepared before it happened, because preparation creates calm, and calm creates opportunity. While everyone else panics, prepared people move with precision. While crowds freeze, prepared people act. And the people who quietly prepare before storms often become the ones who build generational wealth afterward. So today, we're breaking down the 3 moves smart people make before every market crash. The moves that protect wealth, create opportunity, and turn financial chaos into advantage. 1. They build cash before they build confidence. One of the strangest things about bull markets is how they slowly convince people they no longer need caution. When prices rise month after month, cash starts feeling useless, boring, weak. People begin treating uninvested money like wasted potential. Every dip gets bought instantly. Every warning gets mocked. And eventually, people become so fully invested that they lose the ability to think clearly. But smart investors understand something most people learn too late. Cash is not just safety. Cash is power. During good times, cash feels passive. During crashes, cash becomes freedom. Because when markets collapse, opportunities appear everywhere. Great companies get discounted. Real estate becomes negotiable. Businesses become desperate for liquidity. Fear creates bargains that only prepared people can take advantage of. But if all your money is tied up in falling assets, you can't move. You become trapped emotionally and financially. That's why smart people start raising cash before panic arrives. Not because they know the exact date of a crash, but because they know cycles always exist. History has never produced a permanently rising market, ever. Every boom eventually creates excess. Every excess eventually creates correction. And every correction rewards people who prepared emotionally before everyone else was forced to prepare financially. Warren Buffett once said that the stock market transfers money from the impatient to the patient. But patience requires liquidity. You cannot be patient if your bills depend on tomorrow's stock price. You cannot think rationally if every red candle threatens your survival. Cash creates emotional stability. It buys time. It reduces desperation. And desperation is where bad financial decisions are born. Think about the psychology of market crashes. Most people imagine crashes are about numbers. They are not. Crashes are emotional events disguised as financial events. The market falls, fear spreads, news channels amplify panic, and suddenly intelligent people start making irrational decisions. They sell quality assets at terrible prices because they need relief more than logic. But people holding strong cash reserves experience crashes differently. They're not forced sellers. They become selective buyers. While others panic about survival, prepared investors think about opportunity. That mindset difference is enormous. And smart people don't just build cash randomly. They create systems, emergency funds, lower debt obligations, multiple income streams, reduced lifestyle inflation. They understand that flexibility matters more than appearances. In every bubble, there are people who look wealthy right before becoming financially fragile. Luxury cars, massive homes, over-leveraged investments, expensive lifestyles dependent on continued market growth. But smart investors quietly avoid becoming prisoners of their own success. They keep margins of safety. Because true wealth is not about looking rich during booms. It's about staying financially strong during collapses. And that's exactly why cash matters so much. It protects not just your portfolio, but your decision-making ability. When fear dominates markets, clear thinking becomes one of the rarest assets on earth. Cash helps preserve it. 2. They reduce emotional exposure before financial exposure. Most people think market crashes destroy money, but often crashes destroy emotions first. Long before portfolios collapse completely, confidence collapses, discipline collapses, logic collapses. And once emotions take control, people begin sabotaging themselves. They chase hype near the top. They panic sell near the bottom. They abandon long-term strategies for short-term relief. That's why smart people prepare psychologically before markets become dangerous. Because emotional resilience matters just as much as financial strategy. One of the biggest mistakes investors make is assuming they can handle volatility because they've never experienced true fear in markets. But everything feels manageable when prices keep recovering quickly. Real crashes test identity. Imagine watching years of gains disappear in months. Imagine seeing everyone around you panic simultaneously. Imagine opening your phone every morning to catastrophic headlines predicting economic collapse. That pressure changes people. And smart investors know this. So before crashes happen, they intentionally reduce emotional exposure. They stop over-consuming financial news. They avoid obsession with daily price movements. They stop attaching personal worth to portfolio performance. And most importantly, they stop confusing investing with entertainment. Modern markets are designed to trigger emotions constantly. Every notification, every breaking headline, every influencer prediction, every dramatic chart. The financial world profits from attention, not calm. Fear keeps people glued to screens. Excitement keeps people trading impulsively. And many investors unknowingly build habits that increase emotional instability during downturns. Smart people move differently. They simplify. They create rules before emotions arrive. They decide in advance how much risk they can truly tolerate. They rebalance portfolios before panic begins. They diversify intelligently instead of emotionally. And they understand a critical truth. If volatility keeps you awake at night, your strategy is too aggressive for your psychology. That's not weakness. That's reality. Because investing is not about maximizing theoretical returns. It's about creating a strategy you can survive emotionally for decades. Consider what happened during past crashes. Many people sold near the bottom not because they lacked intelligence, but because their emotional threshold was overwhelmed. Fear became unbearable. Losses felt permanent. The future looked uncertain, and uncertainty is one of the hardest psychological experiences humans face. Smart investors prepare for that uncertainty before it arrives. They study history. They remind themselves that crashes are normal, not exceptional. They understand that volatility is the price of long-term growth. And because they accept this reality emotionally ahead of time, they react differently when chaos appears. Another thing smart people do, is reduce ego exposure. That matters more than most people realize. During bull markets, many investors become emotionally attached to being right. They identify with winning trades. They tie confidence to rising prices. But markets have a brutal way of humbling ego. Crashes don't care about your predictions. They don't care how smart you think you are. So intelligent investors stay humble early. They admit uncertainty. They accept they cannot perfectly time markets. And because they don't build identities around being invincible, they adapt faster when conditions change. Emotional flexibility becomes financial survival. The reality is simple. Market crashes are not just tests of strategy. They are tests of emotional endurance. And the people who prepare mentally before panic arrives are usually the ones still standing after everyone else exhausts themselves emotionally. 3. They study human nature instead of headlines. Before every market crash, there's always a story people desperately want to believe. A reason why this time is different. A narrative explaining why old rules no longer apply. In the dot-com bubble, people said profits didn't matter anymore. In the housing bubble, people claimed home prices could never fall nationally. Before countless speculative frenzies, crowds convinced themselves that risk had somehow disappeared. But smart people know something history repeats endlessly. Technology changes, markets change, industries change, but human nature barely changes at all. Greed, fear, envy, herd mentality, overconfidence, panic. These emotions drive markets more than spreadsheets ever will. That's why intelligent investors study psychology more than predictions. Because the warning signs of crashes rarely hide in secret formulas. They hide in human behavior becoming extreme. Smart investors watch for excessive optimism. They notice when people stop asking about risk and only ask about upside. They notice when speculation becomes social status. When everyone suddenly becomes a genius in rising markets. When caution gets mocked. When leverage becomes normal. When patience disappears. These patterns repeat constantly throughout financial history because humans consistently struggle with moderation during periods of success. Think about how dangerous collective confidence can become. The more prices rise, the more people believe rising prices prove intelligence. Eventually, investing stops being about value and becomes about momentum psychology. People buy because others are buying. Fear of missing out replaces analysis. And once emotional momentum takes over, bubbles become self-reinforcing. Prices rise because people expect prices to rise, until eventually, reality intervenes. Smart people recognize these emotional cycles early. Not perfectly, but early enough to become cautious while others become reckless. They pay attention to sentiment, not just statistics. They understand that when everyone agrees markets are unstoppable, risk is often highest. Because markets become most dangerous when people stop believing danger exists. Another move smart investors make is filtering noise aggressively. During unstable periods, information overload becomes toxic. Predictions explode everywhere. One expert says, collapse is coming tomorrow. Another says, markets will rise forever. Financial media turns uncertainty into drama because drama captures attention. But smart people know most headlines are reactions, not guidance. They focus on fundamentals instead of emotional narratives. They ask deeper questions. Are valuations detached from reality? Is debt expanding too quickly? Are people investing from analysis or desperation? Is speculation replacing discipline? Those questions matter more than daily predictions. Smart investors also understand that crises create emotional contagion. Fear spreads socially. During crashes, people don't just react to numbers. They react to each other's reactions. Panic becomes viral. And this is why independent thinking matters so much. The crowd feels safest emotionally, but historically, crowds often become most irrational at extremes. Buying euphoria feels comfortable near tops. Selling panic feels comfortable near bottoms. Smart investors resist both emotional extremes. They don't blindly follow consensus. They step back. They observe behavior. They remain students of human psychology because understanding people often reveals more about markets than understanding charts. One fascinating reality about crashes is that warning signs usually look obvious in hindsight, but ridiculous in real time. People rarely recognize bubbles while emotionally benefiting from them. That's why self-awareness matters. Smart investors constantly question their own assumptions. They ask whether excitement is influencing judgment, whether optimism is clouding discipline, whether social pressure is distorting decisions. This level of self-awareness is rare because it's uncomfortable. Humans naturally want reassurance from crowds, but markets reward independent discipline repeatedly across history. And the people who survive crashes best are often the ones who studied human nature deeply enough to recognize when collective emotions became unsustainably extreme. The real secret: preparation creates opportunity. Here's the truth most people discover too late. Market crashes are terrifying for the unprepared, but transformational for the prepared. That doesn't mean smart investors enjoy crashes. It means they understand them. They understand that downturns are not interruptions to the market cycle. They are part of the cycle itself. Every major fortune built through investing survived periods of fear, uncertainty, and collapse. The difference is that some people enter crashes fragile, while others enter them ready. And readiness changes everything. Think about the greatest investors, entrepreneurs, and wealth builders in history. Many of them made their biggest moves during moments when everyone else froze. Why? Because opportunity hides inside emotional overreactions. When fear dominates markets, assets become mispriced. Quality companies become undervalued. Long-term investments become available at discounts impossible during euphoric periods. But only people who prepared in advance can act decisively during chaos. Preparation is what turns panic into possibility. And preparation isn't glamorous. It rarely gets attention during booming markets. Nobody celebrates cash reserves at the top of bubbles. Nobody praises patience while speculation dominates headlines. Nobody admires discipline when reckless risk-taking looks smarter temporarily. But eventually, reality returns. It always returns. And when it does, preparation suddenly looks like brilliance. The smartest palm people understand that wealth is less about prediction and more about positioning. You do not need to predict every crash perfectly to protect yourself and create opportunity. You simply need systems strong enough to survive volatility and flexibility strong enough to capitalize on fear. That means building cash before confidence disappears. It means preparing emotionally before panic spreads. It means studying human behavior before crowds become irrational. And perhaps most importantly, it means understanding that financial success is deeply connected to psychological discipline, because markets are ultimately emotional arenas. Human beings create bubbles. Human beings create crashes. And human beings repeatedly forget the lessons history already taught them. But those who remember those lessons quietly separate themselves over time. So the next time markets feel unstoppable, pay attention. Watch how people behave. Watch how confidence changes conversations. Watch how quickly caution becomes unpopular. Because the moments before crashes often look strangely similar to the moments before every crash that came before. And while most people chase excitement during those periods, smart people prepare for reality. That preparation may not feel exciting in the moment, but when storms arrive, preparation becomes power. And in the end, that's the real difference between people destroyed by market crashes and people transformed by them. One group reacts emotionally after the world changes. The other prepared mentally before it did.